You are listening to And If Love Remains, a unique show spotlighting people, ideas, science, culture, and art. Your host, Mike Lovett.
Hello, Rachel. Yes, this is your podcast in the sky, And If Love Remains. Let's talk bake runs, shall we? It seems to be hot news in the news today. Bank runs are a fascinating and complex phenomenon that have been the subject of much study and debate among economists. What I want to talk about and explore bank runs from the Austrian perspective and examining the underlying causes of the event and the potential policy responses that can be employed to mitigate their impact. First, it's important to understand that what a bank run is. In essence, a bank run occurs when a large number of depositors suddenly withdraw their funds from a bank. This can happen for a variety of reasons, such as loss of confidence in the bank's ability to repay depositors or rumors about the bank's financial health. From an Austrian perspective, bank runs are the result of fractional reserve banking, which allows banks to hold only a fraction of their deposits in reserve while lending out the rest. This system creates a delicate balance as banks must maintain the confidence of their depositors in order to continue operating. If depositors lose faith in the bank's ability to repay their deposits, they may rush to withdraw their funds, creating a self-fulfilling prophecy as the bank is unable to meet the sudden demand for liquidity. This phenomenon is exacerbated I'm going to use exacerbated by the government's role in regulating the banking system. Central banks, for example, often engage in monetary policy that can create boom and bust cycles in the economy. And let's remember that the boom and bust cycle is caused by government regulation and its role in the economy. It's not a natural thing in capitalism. When central banks increase the money supply, it encourages banks to engage in more lending and expand their balance sheets. This can lead to a credit boom, with many borrowers taking out loans that they may not be able to repay. When the credit bubble inevitably bursts, many banks are left with bad debts and insufficient reserves to meet the sudden demand for liquidity from depositors. In addition, governments can provide implicit or explicit guarantees to banks, such as deposit insurance or bailouts, which can create moral hazard. Banks that know they will be bailed out by the government are less likely to exercise prudence in their lending practices, as they do not bear the full risk of their actions. This can lead to excessive risk-taking and a greater likelihood of bank failures. So, what can be done to prevent bank runs? From an Austrian perspective, the answer is to eliminate fractional reserve banking and allow banks to operate on a 100% reserve system. Under this system, banks would require to hold all of their deposits in reserve, meaning that they could not lend out more money than they have on hand. This would eliminate the risk of bank runs, as depositors would always be able to withdraw their funds on demand. However, this proposal is often met with skepticism, right? As it is seen as too radical a departure from the current system. Critics argue that a 100% reserve system would limit the availability of credit and make it more difficult for borrowers to obtain loans. Proponents counter that this is a feature, not a bug. Let's remind ourselves the number one role of a bank is risk assessment. It's protecting the money that we have given it steward over. So that's its number one thing. It's a feature, not a bug, as it would encourage more prudent lending practices and reduce the risk of financial crisis. In the absence of a 100% reserve system, there are other policy responses that can be employed to mitigate the impact of bank runs. One option is to provide deposit insurance, which guarantees that depositors will receive their funds up to a certain amount, even if the bank fails. This can help maintain the depositor confidence and prevent bank runs from occurring. However, deposit insurance also creates moral hazard, as banks may take on excessive risk, knowing that the government will cover their losses. And as we're seeing today, that is absolutely happening even to the nth degree, as the government's going to be covering seemingly all deposits that have just been lost. Another option is to provide lender of last resort facilities, such as those offered by central banks. These facilities allow banks to borrow from central bank in a time of crisis, providing them with the liquidity they need to meet the sudden demand for withdrawals. However, this can also create a moral hazard, as banks may and have and will take on excessive risk, knowing that they have access to a lender of last resort. Ultimately, the Austrian perspective would argue that these policy responses do not address the root causes of bank runs, which are the result of fractional reserve banking and government intervention in the banking system. While deposit insurance and lender of last resort may provide temporary relief in times of crisis, they do not address the underlying instability of the fractional reserve system. Instead, the Austrian perspective would advocate for a market-based approach to banking, in which banks are subject to the discipline of the free market and must compete for depositor funds based on their ability to provide safe and reliable banking services. This would require the removal of government guarantees and regulations that distort the market and create moral hazard. In a free market banking system, banks would be forced to maintain a strong balance sheet and prudent lending practices in order to attract depositors. This would eliminate the risk of bank runs, as depositors would have confidence in the safety and stability of the banking system. In addition, banks would be free to innovate and develop new financial products and services to meet the needs of their customers without the interference of government regulations. Of course, the transition to a free market banking system won't be easy. It would not be easy, and would require a significant overhaul in this current regulatory and legal framework. However, the benefits of a stable and efficient banking system that operates on market principles would far outweigh the cost of such a transition. So to finish up here, bank runs are a complex and multifaceted phenomenon, but they are the result of two things: fractional reserve banking and government intervention in the banking system. From an Austrian perspective, the best way to prevent bank runs is to eliminate fractional reserve banking and allow banks to operate at a 100% reserve system. In the absence of this, policy responses such as deposit insurance, lender of last resort may provide temporary relief, but it doesn't address that instability that is just the root of the banking system, the root of the problem, in the banking system. A market-based approach to banking, in which banks compete for depositors' funds based on their ability to provide safe and reliable banking service, is the best way to ensure a stable and efficient banking system. And by the government, it's funny, by the government bailing out depositors and allowing banks to completely really run on a 0% reserve system, or 0% reserve system, where they don't have to have any money in reserves. They're literally printing new money every single time they make a loan. Creates so much instability. It's really, really important that we find solutions, whether that's Bitcoin, gold. It's clear to me that the banking system is 100% broken, and we need to find a different way.
You are listening to And If Love Remains.
The first of 23 installments requested by Dr. Levitt. trying to be in compliance here because we're taking him and that whole organization down.